and I was extremely confident in the outcome.
The American investor Michael Burry, famous from the movie The Big Short, being the man who a decade and a half ago predicted the global financial crisis and made a fortune shorting the housing market, has now just issued a dire warning about what he thinks will be the mother of all crashes. After taking a 10-week break from Twitter, he has now returned, and his thoughts on stocks and cryptocurrencies are concerning to say the least. Before he took his break, he was already putting out warnings. February 21st, writing that speculative stock bubbles ultimately see the gamblers take on too much debt, causing margin debt popularity to accelerate at peaks. He thinks that at this point the market is dancing on a knife's edge, and apparently he sold off a large part of his stock portfolio, as well as buying hundreds of millions of dollars worth of Tesla put options that have all made him a lot of money at this point, since Tesla has in fact been struggling the past few months. But now his very first tweet after coming back to Twitter was very bold and worrying, writing, "People ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things, by 2 orders of magnitude." It is clear as day that Michael Burry is critical of all the recent stimulus and of the Federal Reserve and their recent market operations. Although many people really needed their stimulus checks, it is no secret that many checks went right into the stock market and pushed up asset prices to the crazy all-time highs we are seeing today. Aside from this, Michael Burry has expressed his worry about the so-called hype groups and uneducated money going into these momentum stocks like GME, AMC, and many other short squeeze stocks. Due to all this stimulus and due to various hype groups on Reddit and other social media, he thinks that fundamental analysis has become less and less of a factor in investing decisions. This is apparent when you look at recent price to earnings ratios in the S&P 500. In a market environment where there is a high focus on fundamental analysis and cash flows, investors are only willing to value a company so high if it doesn't have that much earnings. For example, historically, investors have not bought a stock that is worth more than around 25 times its earnings, and every time this ratio skyrockets, we also tend to see a market crash. This happened in the IT crash in the early 2000s and during the financial crisis of 2008, and now in 2021 we are again seeing prices to earnings ratios reach new heights, being at around 44 at this moment. It is a clear sign that we are moving more and more towards hype, hopes and expectations of future earnings growth rather than looking at the current earnings of the company. Michael Burry just mentioned this as well in another tweet, saying that all hype/speculation is doing is drawing in retail before the mother of all crashes. Parabolas don't resolve sideways, and when crypto falls from trillions or meme stocks from tens of billions, losses will approach the size of countries. History ain't changed. Keep in mind that this is even coming from someone who initially introduced a lot of people to GameStop stock, and someone that in multiple occasions have mentioned that he likes Bitcoin and that he is in fact not short Bitcoin. But when new retail investors buy assets just because they are going up, they also will sell that asset when it eventually goes down. And that takes us to the next contributing factor in Michael Burry's expected mother of all crashes, and that is leverage. In the same series of tweets, he wrote that the problem with crypto, as in most things, is the leverage. If you don't know how much leverage is in crypto, you don't know anything about crypto, no matter how much else you think you know. What he means with this is that no matter how bullish you and I might be on crypto and its future, leverage can still lead to a massive crash. You see, an asset can only go down so much before all the leveraged investors out there start getting margin calls from their banks and brokers. The bank only wants to lend you money if they are sure that you can pay it back, and as soon as all the speculative investments start to go down, the bank will ensure that it gets its money back and force you to sell off your assets. This in turn causes those assets to keep going down in price and trigger even more margin calls, forcing even more investors to sell off their assets and causing chain reaction, which can lead to a severe market crash. Now, although Michael Burry thinks that there is massive massive leverage in the crypto market, we can never tell for sure. In the stock market, on the other hand, we know for a fact that there is insane leverage right now, and that any ounce of uncertainty could cause or trigger this reaction mentioned earlier. Which takes us to the last piece of this puzzle, and that is Michael Burry expecting hyperinflation ahead that the Federal Reserve will not be able to control. In one of his recent tweets, he linked the Wall Street Journal article that discusses the Fed's conclusions from their latest meeting. The Fed admitted that inflation was happening faster than expected, and that they might have to start increasing interest rates and reducing their quantitative easing earlier than expected. On this, Dr. Burry commented that the Fed is not wrong. If inflation exceeds 2% too much or for too long, it might lead to businesses and consumers to anticipate more inflation in the future, which can become self-fulfilling. #prophecy whistling past the graveyard. It is clear that Michael Burry expects high inflation ahead, and that the only way the Federal Reserve can stop this is to start tapering and increasing interest rates before it is too late. But that can in turn lead to a market crash, since there are just so many companies out there that would be devastated if the Fed would start tapering now. The easy access to low interest cash has enabled all the higher multiple growth companies to invest in themselves without the need for making that much money. The same goes for both institutional investors and retail investors. As interest rates go up, people will want to sell off their stocks and save their money through treasury bonds instead, and other bonds, and all the stocks that have been driving up the stock market will come right back tumbling down. For this reason, Michael Burry believes that tapering won't happen until it is too late, and that we will instead see a crash in treasury bonds. Now that we know Michael Burry's opinion, what does he do to prepare himself for this coming market crash? I might go through his latest stock portfolio update in a separate video, but quickly summarized, he is going short on treasury bonds. For example, owning millions of dollars worth of 20-year treasury ultra short securities. He's also going long on commodities and even farmland, while investing in companies that are making their money right now instead of in the future. Stocks like Google, Wells Fargo and CVS are all owned by Michael Burry's fund Scion Asset Management, but only time will tell whether Michael is right once again. Let me know guys what you think in the comments down below. Do you agree with Michael Burry, or is he just spreading fear in the markets? Please consider liking the video if you want to see more future content on this new channel, and subscribe to the channel to see more investing updates. Thank you for watching, and I will see you very soon.